Good morning, it's Jeffrey Christian from CPM Group. Friday, the 25th of February, about 11:15 here in New York. Going to talk about what's happening in the markets. I had hoped to talk about hedging for producers. It's something that I had talked about. We gave a presentation in the middle of January, hedging for investors, and then we followed that up with hedging for investors too in early February, and I said I was going to do one on producers, but I haven't gotten to it. I want to talk a little bit about hedging today, but given the reality of what's been going on and the precious metals price behavior that we've seen, a lot of people have encouraged me to delay talking about producer hedging right now and talk about what happened and what we think might happen next. My title, as you saw, was Gold and Realpolitik. Realpolitik is a concept that was developed in the 70s, which basically divided or separated issues on an international basis. So you could say, well, we really don't like what you're doing with your people or or in Vietnam, but we're going to continue to trade with you for a variety of reasons, et cetera, et cetera, et cetera. Russia has always sort of taken that approach. You know, we hate your guts, but we'll still trade with you. Or Mr. Khrushchev said in the 1950s, the United States will sell us the rope with which we will hang them. Well, it didn't work out that way, but that we don't always get our projections right. What happened? A lot of people were surprised. They weren't surprised when the price of gold shot up to 1976 yesterday after the Russians invaded the Ukraine. They were surprised when the price fell $98 and got down to about $1,878. It's the old buy on the rumor, sell on the news. If you have a sense of markets, you've seen this happen, and you've seen it happen repeatedly. We issued a gold trading recommendation, one of our short-term trading recommendations, on February 23rd. Gold was about $1,902 at the time. And we wrote, assuming that Russia makes a more violent concerted military invasion of the Ukraine, gold prices seem more likely to rise in a spike, as they did on Monday night when they announced the recognition of the two breakaway republics in eastern Ukraine, and Asian trading on Tuesday before dropping back. We had suggested that the price would spike and then it would drop back. And that's what happened. What happened politically is that, you know, Russia invaded Ukraine, as everybody had expected for months, or everybody, the legal term, reasonable person. All the reasonable persons had expected an invasion. They invaded. The US and Europe slapped their wrists with some of the most ineffectual sanctions that you could have possibly imagined. We did not say that we wouldn't buy their gas, natural gas and oil. We did not say that we wouldn't buy their platinum group metals and wheat or anything else. We'll continue. Basically, the United States and European governments showed the world that they didn't really necessarily care about Ukraine. And in fact, they have some benefits to the Russian invasion in the Ukraine. Markets initially rose sharply. Oil got over $100, gold shot up, silver got to 25.67 or so, platinum and palladium rose. And then the markets realized that the Ukraine wasn't all that important to Europe and the United States in terms of economics and international politics, except insofar as the Russian invasion, A, makes the US and NATO defense industries much more relevant than they had been for a while, and B, really sidelines Russia as an international political player for a long, long time. Yeah, Russia gets the Ukraine, and it will be faced with terrorism terrorist attacks for as long as there are Russian troops in the Ukraine. A lot of people are dying. A lot more may die. Russia will show that it is, as Russia has always been, an extremely brutal political regime, and it will be bad. And they will be bogged down in the Ukraine for as long as they're there. And there will be a lot of things. I think I mentioned a few weeks ago, the United States has shipped in more than 350 Javelin anti-tank missiles into the Ukraine since December. And a lot of those weren't put on the border to protect from an invasion by the Ukraine. They were sited around Ukraine to fight an insurgency after the Russians were in there and dispersed. And the same is true with small arms and a variety of other things. So Russia is going to be one of the losers there. The United States and Europe will not help politically. And, let me shoot ahead. On the 5th of December, 1994, an international agreement was reached. The Ukraine agreed to dismantle its Soviet-era missiles and nuclear warheads and programs. And the US and the UK promised security assurances to the Ukraine government and aid against any threats. Let me get this quote. Threats are the use of force against the territorial integrity or political independence of the Ukraine. Belarus and Kazakhstan were included in the agreement, as was Russia, by the way. So, as the Afghans learned the hard way, the United States has a level of loyalty to its allies and a level of honoring its international commitments for protection and assistance that defies discussion. Winners, as I said, the US government wins, NATO wins. There was discussion of its relevance. Its relevance is now proven. Western military contractors win. China wins because Russia, which actually is not all that friendly with China, China has Russia distracted on the West now forever. And when I say Russia and China are not that friendly, yes, there's a lot of public rhetoric about their friendship will last forever, BFF and all that stuff. But if you study the relationship between the commissars and the Chinese courtesans, you would see that there was a big schism in 1950s when Khrushchev denounced Stalin, and the Chinese said, no, Stalin, Uncle Joe wasn't all that bad. In 1962, when China invaded India, Russia actually supplied more advanced arms to India and delayed its arms shipments to China. So it sort of sided with India over China. And you've seen that kind of friction forever. You don't have to go back to ancient history from the 50s and early 1960s to see that. So they're not exactly, they're good weather friends. They're real politics. The dollar wins. And as I said, Russia will lose. Now, what happens next? Well, the gold price spiked up and now it's come back down. It's trading at about 1890 something as we speak. And our expectation is that you could see a little bit more downward momentum. The big three factors that have been pushing gold prices up really for the last several months are interest rate expectations. The idea of rising interest rates is actually helping push gold prices higher because the idea that interest rates are rising is seen as an indicator of more worrisome inflation. Inflation is the second factor. It's interest rates, inflation, and the risk of a Russian invasion of Ukraine. So the third factor is gone, and it will fade in a surprisingly fast fashion from headlines in the United States and Europe. It'll be there as a subtopic that will be discussed, but unfortunately, we'll start pivoting back to trans children in schools and book banning and who's going to be the next Supreme Court judge, and as if that actually matters. So our expectation is that the gold price will come back down and already has come back down, and it will trade. We think there's a little bit more downside in the initial area, maybe a spike down to 1870, maybe a spike down to 1860. But that, as we've been saying all along, given our views of interest rates, inflation, overall economic activity in the stock market, et cetera, our expectation has been that the gold price would move sideways for most of 2022 and possibly start showing more strength toward the end of 2022 into 2023. And that is where we think we will be. So the spike higher in gold prices yesterday was the fond memory, similar to the spike higher in gold prices in August of 2020. Silver prices got up to, like I said, 25.67 or so yesterday. They've come back down, and we think that silver still remains a little bit more vulnerable to the downside than gold. We have an initial target of $23 in our silver trade recommendations for short-term investor clients. And we think that the silver market is a little bit more vulnerable to the downside, partly because there are a lot of investors who came into the market last year based on a lot of things that were not really legitimate concepts about this world running out of silver and silver production falling, and there's no silver left to mine, and the silver is pouring out of London and New York. We had a little bit of a technical issue there. I was saying that, despite the continued commentary about how the world's running out of silver, silver inventories in London, New York, Shanghai are either at record levels or near record levels, and they're much higher than they have been prior to, say, 2020, 2021. So silver market is facing some dissatisfied investors who drank the Kool-Aid, and now it's worn off. Platinum and palladium rose. It's interesting because they're perhaps more important vis-a-vis Russia, and they were somewhat more subdued than gold and silver, perhaps. We have seen the prices rise. We've discussed it in the past. The fact is that, the Russians and the Soviet Union before it have never really used exports as a political weapon. We wouldn't expect them to do so now. So we don't think that there'll be supply disruptions, nor do we think that the United States and Europe will try to impose import restrictions on it, because the auto industries in both regions are suffering as it is, and they need the platinum, palladium, and rhodium to make the catalysts to make the cars. No platinum, palladium, rhodium, no car sales. So we don't think that they will do that, because, quite frankly, they've shown that they have no interest in actually imposing any sanctions that cause pain either to Russia or to the United States. Let's be honest. If they really were serious, they would cut off oil and gas exports, and they would cut off all financial transactions overseas, not kicking them off of the SWIFT, because that would be a bad thing for the West, but simply freezing Russian assets. I mean, they were really serious, they would have frozen some assets of Putin's, but they haven't. Strange why they did that. Neither here nor there. So platinum and palladium, we've seen platinum rise up to $1,100. Our view is that platinum does have some long-term benefits going for it. Palladium will remain strong because of concerns in the market about available supplies. What I want to talk about next is hedging. As I said, we were going to talk about hedging for producers and others was the working title. And it still is the working title of a draft presentation that I'm pulling together on that. But wanted to talk about what could have been done this week. This was a hedge that we put together actually for investor clients on Tuesday, the 22nd. This was after Putin's big speech about how he really wants to go back to the 17th century when Russia was the third largest economy in the world and was a rival to France and the UK. And then he said that he was going to recognize the breakaway republics in eastern Ukraine and send in more Soviet troops, Russian troops rather, to defend the Russians that were there from the genocide being imposed, reaped upon them. And the price of gold spiked up on his speech, and then it came back down. Tuesday, the price was at $1,905. And we said to a client, okay, you've got gold, you want to stay long, you're a long-term investor, but you could buy a put at 1875 and you could pay for it with a call spread. And the call spread was between two, you would basically sell a call at $2,025 and buy another call at $2,075. That call spread would generate a net premium, which would pay for the put. So it's a zero premium hedge. You would have a put at 1875 if the price really fell sharply, almost as sharply as it did yesterday. And you would only give up $50 if the price rose above $2,075, which would be a record price. So you would have a contingent premium, if you will, that you would only pay if the price was over $2,025. And we pointed out that the price doesn't need to fall to 1875 for that to be profitable. And I'll show you something over the next two slides to explain it all. So we priced that on Tuesday morning at 1905. Fast forward 2 days, the crisis had grown worse, and the price, the Russians have actually invaded, and the price has spiked up, got as high as $1,976, and it had come back off by Thursday morning to $1,964. We repriced that 1875 put, and we said, okay, you can receive the price all the way up to 2025, and then you would give up that $50. So it's basically the same sort of hedge that you had. And I should point out, these were very short-term hedges for April COMEX futures options, so they would expire in late March. So this was just playing this position, just putting this hedge in place for really a month. This morning, well, yesterday the price fell down to $1,878, which surprised a lot of people. This morning the price was $1,889, and we repriced that. You could have taken that put. You would have paid $8.80 outright for an 1875 put, April put that expires in late March. Yesterday morning, you would have paid $8.80 outright, or you could have done our strategy and gotten it for free. $8.80 on Thursday morning. By Friday morning, the price had fallen down to $18.89, and that put was worth $25.40. You could have sold it back into the market, made $16.60, which would have been an 89% profit on your hedge in a day. You could also have taken that call that you sold and bought it back. It generated a net proceed, a gross proceeds of $21 yesterday, Thursday, and it was worth $4.50. So for $4.50, you could have liquidated that, and then you'd have full exposure all the way up. And you would have that other call that you had bought, you could just leave it there. And if the price did rise to record levels, it would make even more. And even if the price didn't rise to record levels, if it rose to $1,950 or $1,975, which is what it had done on Wednesday night, Thursday morning, you could have sold it back for a profit too. And kept your long position in physical gold or futures gold or whatever you have, ETFs, the whole time. So that's how you can harvest profits from hedges. You can buy a hedge because you want to protect yourself from the downside. But if the price falls to a level where you say, okay, I think the downside's over now, you can actually take profits out of that hedge, all the time preserving your long physical position. I know there are trolls out there who will say blah, 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 blah. And I know that smarter people than me keep telling me to just ignore them. So I'll ignore them. This is the reality. Some of our hedging stuff on our website. We have presentations where we go into details about it, and presentations on our hedging services. We are working on our gold yearbook, which will come out in the first week of April, 200 some odd pages. This is a copy of the 2021 yearbook, and you can see I tagged certain pages so that I can look at mine production that's under development, that's coming on stream, costs of production, and the most important one, the ratios and correlations between gold price changes and things like inflation, the stock market, the bond market, and the dollar. You can order that yearbook online. You can buy other services of ours. We have a variety of things. Later in March, we hope to have metals, energy and metals and materials discussion, presentation, online seminar, talking about some of the implications for platinum group metals, as well as manganese and hydrogen and other metals and materials that may or may not be used in future mode of transportation. That's all I have for today. Sorry about the technical glitch halfway in between, but I think we'll be able to edit it smoothly, and we'll talk to you next week.